So just give it a minute for people to get in. I think go ahead, David.
Good morning, afternoon, and evening, everyone. I'm David Levy from BentallGreenOak, and I'll be the moderator for today's session, posing questions, as well as facilitating yours. You can post questions or comments during the session using the Q&A function, and we will try to field as many questions as possible. You know, the turnout for today's webinar is quite significant. The atrocities occurring in Ukraine are front and center on the world stage. And to a degree, this recognition is indicative of the size and breadth of today's audience. Approximately 500 individuals from around the globe have pre-registered for today's event. And while close to 80% of these reside from the US across 42 states plus Puerto Rico, we also have audience representation from Canada, India, other parts of Asia, Australia, South America, the Middle East, and actually a dozen countries from the UK and Central and Western Europe, including England, France, Germany, Spain, Belgium, Austria, Greece, Italy, Turkey, Czech Republic, Slovenia, and even Ukraine. And if Arthur is on, I welcome you. The other reason for today's large audience is really to hear from our speaker, esteemed economist, Richard Barkham, CBRE's global chief economist and head of global research. Based in Boston and a fellow member of the New England chapter of the Counselors of Real Estate, Richard leads a team of 700 researchers worldwide while traveling and speaking extensively on key economic and real estate trends globally. So with that, Richard, maybe perhaps I'll turn it over to you for some opening remarks before I pose my first question, which is, will the war in Ukraine cause a recession in the global economy?
So thank you, David, and good morning, good afternoon, good evening to everybody on the call. Before I start dealing with the economics of all of this, I just would want to say we're very mindful of the grave human tragedy that is playing out in Ukraine right now. And as much as that we have to try to assess the economic impact, we are absolutely not blind to the suffering of the Ukrainian people. So I just want to get that on record, and insofar as we can show solidarity, we will try to do that. So and good luck to all our colleagues in that area of the world as well, I would say. So the opening question, will the war in Ukraine cause a recession in the global economy? Well, first, let's say I think that the discussion of the word recession in the global economy has gone up the agenda, I think, over the last 6 months or so. There are a number of headwinds against the global economy right now. But I don't think in and of itself, the war in Ukraine is quite enough to cause a recession. And I'm going to be dipping in and out of my slides, David. Let me just share a slide that I hope doesn't seem insensitive, but just attempts to put geopolitical events into some sort of context. It's a slide I show quite a lot. But let me just share my screen and show you this opening slide. So, and if I just go to this one here. So my general feeling on geopolitics is that it doesn't typically derail the economic cycle. Now, what do I mean by the economic cycle and how have I showed it? What I've got here is the last maybe 40 years of economic growth and change in the United States. And I'll talk about why I'm focusing on the United States in a moment or two, but just let me explain the chart. I think the best measure of the global economic cycle is just unemployment. It's a very well observed economic variable, and you can see 4 clear cycles in the United States economy here, going back to 1980. You can see the early 1980s recession, and some of us who were in real estate then will remember that. And then the long recovery through the 1980s, the late 1980s recession where unemployment rose again, and then the long economic expansion in the 1990s. Then we had in the early 2000s the tech crash, another rise in unemployment, and then a relatively short cycle, 6 to 7 years, and then we had the great financial crisis, where that unemployment really shot up, and the long expansion, slow and steady over the last 10 years. And finally, at the end, you got the impact of COVID coming through, which is, a little bit it's just a little bit different to the other kind of more regular economic cycles. I would say as well that although I've shown this for the United States, this also works if you put the G7, the group of 7 large economies. If you look at their average unemployment rate, you get pretty much exactly the same shape. And remember, the G7 economies are United States and Canada, Japan, and then the UK, Germany, France, and Italy, the big European economies. And my point here is what I've tried to do on this chart, because it shows the 4 big cycles in the US economy and the one-off shock from COVID, is that I have tried to put other quite important geopolitical events on this slide. And some of them are small, just kind of one-off events, and some of them are quite big in terms of wars, and wars with major resource-producing economies. So, but we've got everything on here. We've had the fall of communism, we've had the Iran-Iraq war, we've had the first Gulf War, we've had the second Gulf War, the invasion of Iraq. We've had all manner of quite important and economic geopolitical events. But what they don't seem to do is disrupt the economic cycle once it's underway. So this is one of my reasons for thinking that the war in Ukraine won't actually have an impact on the cycle. To my mind, what impacts the cycle, what brings it to an end, is usually around inflation and interest rates. And now we do have something to say about that, because that we are at a time of rising inflation and rising interest rates. So that's why I say in and of itself, the war in Ukraine, I don't think will disrupt the global economic cycle. Whether by adding to the pressure on inflation, which already exists, whether by pushing up interest rates, which are already heading upwards, it has some impact. I would say that's entirely possible. But I don't just think on its own there is enough to destabilize. And I even now think that the global economy has even despite the hits that it's taken over the last several months, there is still quite a lot of momentum in the global economy. I see the war in Ukraine, somewhat akin, I think, to 9/11. It's happened at a time. 9/11 happened at a time when a recession was already happening. I don't think it had much additional impact. In fact, it may have even stimulated, some fairly strong economic policy at the time. But it nevertheless is an event that changes the way we think about the world. It realigns geopolitical attitudes. It's a momentous event. And, we'll probably still be thinking about the world in the light of this Ukraine crisis in the next, over the next 10 years, possibly the next 20 years. But I don't think it's economically damaging, even if it is a human tragedy and a geopolitically, important event. So that's rather a long answer to the question that you asked, David. I'm sure you want me to clarify, but let me hand it back to you.
So the main impacts then may just escalate what is already existing from an inflation standpoint and interest rates?
Yes, I think so. What we've got an inflation situation in the developed economies, in fact, around the world, that's come out of the pandemic. And there are, one of the reasons for that is just what we call in economics a supply shock. The pandemic disrupted global supply chains and made it more difficult for people to buy the goods that they wanted to do. At the same time, we had a huge amount of stimulus in the global economy, enacted across the developed economies and less developed economies. So you just had that kind of pressure of demand and, particularly focused in on the goods sector of the economy. People during the pandemic couldn't get out and spend in hotels and restaurants. So people basically sat at home and bought things on the internet, stationary bikes, rowing machines, consumer durables, consumer luxuries. So you had that kind of pandemic stimulus butting up against this supply shock of disrupted supply chains. So you've had an inflation surge, and that has also this COVID. The war in Ukraine is only going to add to that.
I saw a forecast today that perhaps the UK would actually have negative GDP for Q2. So maybe it's much along the lines of what happened after 9/11. It's short-lived, and then we'll rebound once it gets through. You feel that way?
Well, funnily enough, I've just had a look at the real-time indicators of the UK economy, and business confidence is pretty robust. Retail sales is pretty robust. It's certainly true that increased gas prices is affecting consumer confidence, and we see that in Europe, and we see that in the United States. And the word gas, you've got to be careful about using, because gas in the UK, in Europe, I'm referring to liquefied natural gas. In the States, I'm referring to petroleum or gas. What goes into cars, but it has the same sort of impact. The price of both of them have gone up, and it's eating into household budgets. But over the course of the pandemic, the household sector and the business sector have been able to accumulate, because of stimulus and because of their lack of ability to spend, quite a lot of savings. So I think some of the impact of heating gas prices in Europe is going to be offset by people drawing down their savings. And the same is true in the United States, except with regard to gasoline. The point is, I'm not so certain. I mean, it looks to me like Q1 has been pretty robust in the UK. I'm not so certain that you're going to get a weak, a negative Q2 in Europe. It might happen. But confidence, stock markets, all looks pretty robust to me. And in the case of the UK, people underestimate how important the US economy is for the UK. So while the US is robust, I don't expect that to feed through into too much negativity in the UK.
So many countries are pursuing sanctions against Russia. Is that a big danger?
Well, I think we've got to remember, I think it is a friction to world trade, but I think people need to remember just how small the Russian economy is. It is a little bit bigger than the economy of Spain, and it is half the size of the economy of California. So it is a small economy. It has an outsized geostrategic position because of its kind of geography. It clearly has world-class capabilities in cyber warfare, and it's obviously got a very large military. But economically, apart from the fact that it is a global producer of many raw materials, and jointly with Ukraine, it's a great big wheat producer, I don't know. It's really interesting to me just how quickly the rest of the global economy is adapting to the sanctions and finding alternative supply pipelines and chains. I don't know that the sanctions themselves are going to be that impactful on the global economy. I don't think that will disrupt the global economy. And as an evidence of that, if that had been very significant, you'd have seen a bigger impact on stock markets, I think. But as yet, and that is a little bit of a hostage to fortune, stock markets relatively resilient over the course of the crisis.
There's recent news even this morning about Russian bond defaults. So any opinion on the impact of that or how that plays out and impact to there are various European banks that have sort of greater exposure to Russia than others?
Yes, again, I think it's not big enough. I think it's not a big enough economic event. Now, there are some uncertainties around a Russian bond default, and we don't know technically whether they have defaulted yet, but you'd have thought that they probably will default. We don't know. It's like a lot of emerging market debt. We don't know who's actually holding it. Probably quite a lot of private equity companies that would invest in higher yield government paper, and some of those themselves might be quite highly leveraged. And I do think a broader emerging market default, maybe in response to rising US interest rates and the strength of the US dollar, I think that could be problematic. But I just don't think that the Russian bond default is big enough on its own, particularly since since the great financial crisis. The capital buffers in the banking sector are just so much better than they used to be. The banking sector, I think, is likely to be resilient to this, even if it does feed through, through private equities writing down their holdings into kind of loan issues. It's just probably not big enough. There are certain banks in Europe that have got direct claims on Russian businesses. And I think the banking sector in Italy, the banking sector in Austria, and the banking sector in France, they're all exposed, I think. So in the banking sector in Italy is possibly one of the weaker banking sectors, which has already got quite a lot of bad debt on its balance sheet that hasn't fully dealt with yet. So I think we'd want to watch out for the Italian banking system, particularly if I'm wrong, and if there is a bigger recession in Europe and it feeds through into Italian sovereign. The Italian sovereign market, which again is held by the Italian banking sector. But I would say at the moment, a default on its own isn't quite a big enough event to damage what is quite a robust banking sector. And globally, the corporate sector is awash with cash. The household sector and the corporate sector in the developed economies, probably for no good reason, too much stimulus during the pandemic, but are all awash with cash, which actually makes them a little bit more resilient at this time of increased stress.
So you talked about raising interest rates. What's the main real estate impact due to the war on real estate?
So, as I said, I think we've got to see that. I would list, there are a number of headwinds to the global economy right now. The war in Ukraine is one of them. The slowdown in China is another. The build-up of inflation, particularly in the United States, and the sort of sense that the Fed is behind the curve is probably, I think, the biggest danger to the global economy and to real estate right now. So those are, and of course, COVID, although it's diminished, hasn't gone away either. So I think, there are a number of headwinds for the global economy right now. And actually, I think the most important is the inflation situation in the United States, which, as we've already discussed, faces, is not immune to events in Ukraine. But clearly, as it now turns out in the United States, I think the US economy was overstimulated during the pandemic. And that huge, and if you'll pardon the term, wartime economic stimulus that we had in the United States now is showing up in just, incredible demand, and with supply chains disrupted, and with actually the labor market really tight in the United States. It's worth talking about that. Then we've got this surge in inflation that's taken everybody by surprise. And that is the biggest danger, because I think, the Fed is now realizing that kind of quite high levels of wage settlements are going through. And this is not a 1970s wage price spiral, but the Fed, I think, realizes that the US economy is overheated, and will want to slow it down. So, people have been talking about 6 interest rate rises in the United States in 2022. Now they're talking about another 6 in 2023, taking, hopefully the terminal value of the Fed funds rate up to 3.5%. This, I think, is the main danger to the global economy right now. Let me just, why have we seen this surge in inflation in the United States? I know you've got other questions. There'll be other questions coming in from the audience, but I think it is worth, this is the heart of the matter. Over the course of the crisis, one of the issues that emerged in the pandemic, as I've said, is people spending a lot of money on consumer durables with disrupted supply chains. But the other one was really the shrinking US labor force. So, over the course of the pandemic, I think we lost 5 million out of the labor force, of which 3 million people had retired. Close to 1 million may have been folks with childcare responsibilities, and schools were disrupted, childcare was disrupted. And just a whole, section of people seem to have, left the labour force to pursue other avenues. So, and there's one final thing as well, which is in any 2-year period over the last 20 years, the US would have had 2 million more immigrants. So and that's partly immigration change, but it's partly the pandemic. There's just, it's acute shortage of labor in the United States. And at a time where you've got a stimulus feeding money into the corporate and household sector, it's really that, demand supply imbalance in the United States that's caused this inflation. The Fed knows it needs to get that under control and to damp down demand relative to supply, or inflation will just keep going. And that is the key issue for global real estate right now: rising interest rates. And there are more hawkish voices in Europe as well, who are talking about pushing European interest rates up, and we've already seen it in Asia too. There are many economies in Asia which are sensitive to the dollar and sensitive to rising interest rates in the United States, and they reacted ahead of the Fed. So this is the key issue for real estate right now.
Do you think, besides Fed policy or central bank policy, that just we're having these waves of COVID too, which is getting in the way of job creation and adding to disruption of supply chains. What's your outlook on? I mean, we've had these repeated waves. They're getting increasingly contagious, but less severe. But it certainly remains a headwind. Do you see where's the pandemic headed, and what impact will it have economically?
Yeah, I mean, I think what we're seeing, I totally agree with you. It's a headwind. There's a new variant at large in Europe, which looked like another surge was taking place in Europe. That's kind of eased back again. I'm sure that there is another surge of this BA.2 is coming in the United States. I think, by virtue of the fact that we've got high rates of vaccination and high rates of natural immunity because people have just had it. There's an estimate that something like 60 million Americans caught Omicron, probably somewhat similar in Europe. I think the developed world is through Omicron and it isn't going to be quite as much of a headwind. But there is a problem, I think, with Omicron in Asia. And, in the context of talking about other factors weighing down the global economy, I think, the flare up of COVID in China and the lockdowns that are taking place there are, a serious headwind to the Chinese economy. And the Chinese economy was already weak because of the attempts of the government, probably well-placed attempts of the government in China to move the economy away from, its total dependence on, or not total, but major dependence on real estate development, housing development, and how that fueled construction and retail sales. Government have been trying to, just ease up on the flow of credit into the residential sector. That has slowed the housing market down as well. So China is extremely weak right now, and the lockdowns in China are not helping. And I think it's entirely possible China will have a recession. Now, a couple of things there. A recession in China isn't exactly the same as a recession in the West. In the West, if we get negative GDP, it's a recession. In China, if you get sub 4% GDP growth, it's a recession. So China won't actually stop growing, but it'll grow well below the trend rate. And in normal times, here's the thing, in normal times, that's a big impact on the global economy and real estate because China's a major driver of the emerging markets, and China and the emerging markets together is 30 to 40% of world demand. So it's a big component of world demand, and world demand obviously feeds through into kind of corporate expansion and the real estate fundamentals. It sounds a little bit distant in terms of the connections that you can make there, but it is really important. And in normal times, I think that is a real headwind, and it's still a headwind for growth. But here's the thing. At a time when the US economy is clearly overheated and is generating too much inflation, having China somewhat weaker than normal, having it also depreciating its currency, and what some people call beginning to export deflation, that might be something not this year, but next year helps us out a little bit. So, we're in a very complex economic world right now. China is slowing, and it's one of the factors that feeds into a general fragility in the global economy and a general sense of nervousness. But actually, the weakness in China might help us out a little bit in terms of the inflation that's coming through from overheating in the United States, and also, the resource shock that's taking place as a result of the war in Ukraine.
So we've covered a lot of negatives. That's one potential positive. Can you run us through again? You had some positive factors that were playing into the economy. I think so. I will want to come back to real estate. I mean, we've talked quite a lot of global macro. We'll come back to real estate, but just, I mean,
given that we've got these 5 shocks, we've got the war in Ukraine, we've got the slowdown in China, we've got inflation in the United States and elsewhere, and rising interest rates, and we've got COVID. You kind of wonder why it is. That feels to me like quite a heavy weight, all those things together. But if you look at the real-time data, the economy seems to be moving along at a decent clip. We've all revised down our forecast estimates for this year and next year, and we've revised up our forecast of inflation, not just CBRE, but the whole forecast community. But if you really look hard at the economy and look at the real-time indicators, they are not dipping yet. So question is, why is that? What's driving that? And I think the real positive from all of, in the global economy right now is just the continued reopening and bounce back from the pandemic. So people have got accumulated savings. The corporate sector is awash with cash, and in the United States is investing very heavily. And just this kind of, as sectors open up, hotel, leisure, everything that we couldn't do during the pandemic, we are still not fully reopened after the pandemic. And that is pushing up growth rates. And at the moment, that's enough to offset some of these other negative impacts. It is quite surprising, I have to say. And I would say, and I've said it once or twice, and I'm going to say it again, that we're entering into a period of fragility in the global economy, which I think, is almost as fragile as we saw during the pandemic. But at the moment, the growth rates are strong. And for all that interest rates are rising in the United States, we've still got inflation. And what economists talk about is negative real interest rates. So what we do is, in economists, we take the interest rate and we take away the inflation rate. You know this as well as I do, and all our colleagues do. So at the moment, if you look at the Fed funds rate or even the 10-year Treasury, and you take away the rate of inflation or expected inflation, you end up with minus interest rates of about -4, -5%. They are historically the lowest real interest rates that we've ever had. And if you want to look at the econometric evidence, and not everybody does, I'll grant you that. If you want to look at the econometric evidence and have a look at what really affects real estate values, it's real interest rates that do the work. So the fact is, in this strange world of economics, negative real interest rates are still very expansionary. And you've got to remember as well, in the United States, we've still got an infrastructure bill that President Biden passed. That's coming in 2023. There's still some government stimulus going in there, despite things being scaled back a bit. So those things, I would say, were the positives. And at the moment, albeit that we're somewhat fragile, that's bowling the economy along, and that is positive for real estate. There's no getting around it. It's positive for real estate confidence, it's positive for fundamentals, it's positive for investor attitudes. And at the moment, despite all of the negativity or the shocks, we're not seeing it in terms of leasing demand or indeed investor demand.
The fragility sounds like a real recipe for volatility, at least in the near term. But
yeah, I would say so. Yeah, I mean, it's a recipe for. Although, having said that, the VIX index has come down in the United States, so volatility is eased quite a lot in the United States. But you cannot expect over the next 18 months, as we move through this rate rising cycle, that there is bound to be other episodes of volatility, particularly with the war in the Ukraine still live, still going on. It compounds. These things compound themselves. So, yeah. And one of the areas of volatility that you may, I'm sure, have been aware of, that we've seen, it's eased, I think, over the last couple of weeks, but we did see some volatility in real estate debt markets over the last 2 weeks or so. With debt rates increased in Europe, 25 to 75 basis points, and probably somewhat similar in the States. And for small periods, just actually, the market's freezing up. So, I think the immediate impact of the war in Ukraine and also the other tightening factors that I've referred to, we're seeing ripple through debt markets. As I say, at the moment, it's eased. I don't think there is any lack of credit available for real estate, but there is clearly a sense in which I think sellers are hurrying to the market and buyers are taking a bit more time over transactions. So you might think that will have some impact on pricing, particularly maybe in sort of grade C and grade B type of real estate in the sectors that are not quite so highly favored. And I have no evidence that that's happening. I'm just making the leap between tightening interest rates, debt market volatility, and an overall loss of feel-good factor in the global economy.
We saw spreads widen significantly, but that certainly has settled down. The bidding pools have certainly gotten thinner. I just wonder whether, given the direction and trajectory of interest rates or future path, a lot of borrowers are now looking at shorter term debt versus longer term. Is that strategic in order to take advantage of where interest rates may go 3, 4, 5 years out?
I'm not seeing that in the marketplace. I mean, it is what you'd expect. It is exactly what you would expect to happen. You go for shorter duration loans, and then refinance at a later period when rates have come down. I don't have any evidence that that's happening, but that it's exactly what you would expect.
And what impact might all this have at the fiscal level? Property taxes are sort of the biggest line item of any property. So what's happening with city, county budgets? We're certainly seeing a lot of reduced services, escalated crime during COVID.
Yeah, I mean, I think it was one of the big surprises. State and local budgets kind of respond to the economic cycle. So, if growth slows, then you would expect to, see some impact on state and local governments. But, with unemployment at kind of 4% or whatever it is, it just vacancy heading down, even in the office sector in the United States, I don't see any danger. It was one of the big surprises, really. If you look at the municipal bond rates in the United States, which really spiked, there was a point at which the state and local government finances at the start of the COVID crisis just looked dreadful. But once the recovery happened and once the stimulus went in, I think that's the market that has shown the biggest recovery of all, I think, state and local government finances. So I don't see any. I would say, you've probably got more impact on property net operating incomes coming from other aspects of inflation than taxation at this stage.
Yeah.
If anything, we might even see tax relief. No, I take that back. That'll never happen.
So are there any regions that will be more affected directly or indirectly?
Yeah, no, that's an interesting point. Yeah, no, I think if we are going to play down the global impact of the Ukraine crisis, then I don't think you can play down the local impact. And clearly, there is a big impact on Europe, and particularly Central and Eastern Europe. So both as countries that are sheltering refugees from Ukraine, but as countries also that have disrupted supply chains that kind of interacted with, Eastern Europe supply chains are going to be somewhat disrupted. I think, the biggest impact there, and then feeding through probably into, core European economies like Germany, which, just is so dependent on Russian gas. I think we have halved our forecast outlook for Europe from in 2022 approximately 4% and a bit growth to about 2.5% growth. So I think the war in Ukraine is going to have a significant impact on growth in Europe, and of course we've got the thing that we haven't talked about yet, which is just the food price inflation. Again, I think the developed economies will be able to handle that because of accumulated savings, but that could feed through into the less developed economies, particularly the big grain importers of North Africa and the Middle East could well cause local instability as well. So I don't want, we may have downplayed the war in Ukraine in terms of its actual economic significance in a global economic context, but the local significance is huge, and it's primarily on Europe, but all of the geographic regions that kind of are close trading partners with Russia and the Ukraine, particularly the Ukraine.
Thinking about global capital flows, by indirect, does the U.S. then become the global safe haven for real estate investment, at least in the short run?
Yeah, I mean, it always does. I mean, the US is the global safe haven. I wouldn't press that too far. I mean, I don't think that we're going to see a big value hiccup to European real estate. In fact, I probably don't. I don't think we'll see much of a hiccup at all. And one thing you've got to remember about the United States is the strength of the dollar. The dollar is going up and the hedging costs are going up as well. So, Asian investors and European investors looking to buy in the United States are going to face higher hedging costs. It's not a big issue at the moment, but it does have a marginal impact of the flowing of capital into the United States, particularly in the big gateway cities. So I think, but all that said, yes, of course, the United States is the global safe haven. I wouldn't want to overstate the risks to Europe, though.
You talked about the performance and benefits of real estate as an inflation hedge earlier. In times of stagflation or recession, that's really not where it does perform. So what do you think the risks are of real estate falling into a condition where it isn't performing the way it's supposed to?
That's a very, very interesting question. And, all of the evidence, as we know, suggests that, real estate is not a hedge. The strict meaning of the word hedge is to, protect you against unexpected events. And we've had unexpected inflation, and I don't think real estate, is particularly good at hedging out unexpected inflation. It might be in certain cases. Retail used to be quite good because of the feed through from consumer spending. I think multifamily and apartment is probably a better hedge now. But I don't, but I think over a longer term period, say 10 years, I think I don't see any danger that real estate won't continue in its historic ability to at least keep pace with inflation, in the longer term. I think we might see office rents not keeping pace with inflation for a while, but then we've got all manner of demand and supply adjustments to make in the office sector. But I can see, industrial and multifamily easily keeping pace, or if not beating inflation, and retail, somewhere in between. So, I think, and alternatives, the thing that investors are interested in, the alternatives, student housing, seniors housing, data centers, all look like they've got fundamentals that are really strong enough to provide that kind of longer term protection against inflation. So it's going to be mixed, and it's not going to be a short term thing, but I don't see any reason why we shouldn't expect real estate to continue to be part of a portfolio, part of the investment world that gives you reasonable long-term capital security.
Maybe at this point, with 15 minutes or so left, I'll turn it over to some of the questions that have been posed. The impact of the war on cap rates across real estate asset classes. So we've talked about that some already with rising interest rates, rising inflation. Are there any particular sectors you think are more vulnerable to decompression?
I mean, you've got to look at sectors where the fundamentals are weak. So that's not apartments and that's not industrial. It's probably not retail either, because in the case of retail, over the one of the things, it may be suffering some secular shifts against it, but we haven't had much retail development for 10 years. And the retail that, retailers have learned to cope with the kind of omni-channel world. So retail in some ways looking reasonably defensive. I would have thought that if you're looking at offices, what we're seeing in the marketplace is a real flight to quality, associated both with companies, trying to return workforces. I mean, I'm talking about the United States. It might be slightly different in Europe, but, you'd have to think of possibly grade B and grade C offices, where the fundamentals are unclear at this stage. They'll probably recover, but are unclear at this stage. They would be the most sensitive, I think, to potential yield shift. But I think, obviously the thing that determines cap rates is, that long-term interest rate, that 10-year treasury, or the 10-year treasury in each different region. You have to say to yourself, even though it's going to go up because of inflation, even, if you've got a temporary inflation, do we really see over the next 10 years, those long-term interest rates being too much different from what they've been over the last 10 years, when we have so much saving in the world, so much global saving to deploy, and you've probably got, both in the United States and Europe, shrinking labor forces, which tends to be associated with lower rates of inflation and lower interest rates. You probably don't see too much longer term secular shift in that 10-year treasury rate, so that, broadly speaking, cap rates within that remain secure.
I have a number of questions that sort of takes us back to the local.
I would just throw in, of course, if I'm wrong on this, and the positive forces that currently prevail in the US, in the global economy, don't stand the test of this, these headwinds, and we do have some sort of recession, and it is a possibility in 2023. Then I think, as fundamentals deteriorate, cap rates in all sectors will be vulnerable. There's no doubt about that. And we've got to remember, in most cases, cap rates don't just drift out. They drift in. They don't drift out. If they move out, they move typically quite quickly. And that would be the response to a recession, I think. And it's not off the cards. It's not the base case, but it is not beyond the bounds of probability at all. Sorry,
the local questions that have been posed are around, Ukraine's a very big supplier of steel for construction for Europe and Canada. And so there's the knock-on effect to construction inflation. Also, who will take the lead in rebuilding Ukraine, public or private entities? And so that in and of itself will be the flood of capital to rebuild Ukraine. And then lastly, it's if NATO got directly involved in the Ukraine conflict, how might that impact global real estate? So maybe we'll talk about which one do you want to, the local impact to prices and costs of construction?
Let's do the easy one first, which is steel production. I mean, I do think there's plenty of steel production capacity in the world. So I think, what has surprised most people and will continue to surprise them is how quickly those supply chains can reorientate. I mean, there's plenty of capacity to produce steel in the United States. On the other hand, these things don't take place overnight, I think. And also, I mentioned it earlier, we've got an infrastructure bill coming next year in the United States. I can't see any early easing on construction costs, really. I just can't see it. Now, in one sense, that is bad for the industry because it restricts the supply of new real estate and leasing opportunity. But it also restricts the supply, the rate at which you can produce new real estate in the longer term. And that itself, I think, kind of protects value. But I don't think there's going to be any early easing in construction cost inflation. Probably one of the last, even as general inflation is coming down, construction cost inflation likely to remain, elevated, I would think. So the next thing that you mentioned.
If NATO were to get involved, what impact would that have on global real estate market?
Well, I mean, I'm not an expert in all of. I'm talking about the economic impact of what has happened already and what is likely to happen. I would say that the battlefield situation remains unpredictable, highly unpredictable, and we just don't know where it will go. But clearly, if the conflict escalates, then that isn't, that's a ratchet up in the headwinds, and it might be the thing that kind of just pushes the global economy into a recession, and that would be negative. But I think and I'm no expert here, others will know better than me. NATO seems to be trying as hard as it possibly can not to become embroiled.
I think the last question is, so we've talked a lot about wage inflation and what the impact of the war on employment on emerging countries. Do we see wages matching inflation hikes in emerging nations versus developed?
It's a good question, and it's not one that I've got an easy answer to. But all of these things come down to demand and supply, and I think most emerging markets have got, if not abundant labor, they've got labor supply. So it is possible, I think, that wages won't keep pace with inflation in the emerging markets in same way as they potentially can do in the developed markets where labor is much scarcer, and therefore you are looking potentially at kind of political turbulence because of that, particularly around food price increases as well, which we've already mentioned. That there are economies where the per capita incomes are much lower, where this is a real kind of day by day impact that maybe not so much in the developed economies, although the developed economies have their own poorer sections of the community as well.
Richard, I think I just want to thank you for your insights. This is an evolving situation, very complicated. And what I'd like to do is turn it back to Michelle for some closing comments on behalf of the counselors of real estate.
Well, thank you, David, and thank you, Dr. Barkham. As you were saying, David, your insights, both of you, your insights and outlook of the impact on the Ukrainian war, on the economy, and the real estate industry. This was so informative and compelling. And again, thank you so much for allowing us to share and to hear your insights on this matter. I'd like to encourage your donation actually to the World Food Program to assist our Ukrainian colleagues affiliated with the United Nations. Donate to WFP.org. And also, I'd like to remind you that on-demand recording are available for most What's Next sessions, and all registrants will receive today's recording. On April 20th, there'll be the webinar on institutional investments in partnership with NAREM. So you can register directly at the CRE sites at cre.org. That's cre.org. Until then, on behalf of the counselors of real estate, thank you for attending this session of What's Next for Real Estate and the Life Experience. Thank you again.